Welcome back to the channel, guys. Today we're gonna continue where we left things previously in the previous video about the rule number 1 of Warren Buffett, and we're gonna focus on the stop loss and re-entry, and we're gonna go through the Excel file. And I also just want to mention a few strategies that you may want to consider if you want to try this method on your long-term investment portfolio. So let's get started. As always, please keep in mind that I am not a financial advisor. The content on this channel and on my website is intended for educational and entertainment purposes only. So let's repeat what a stop loss is. It's basically what the name, like stop your loss. So you're gonna, after you make an investment, you're gonna decide beforehand, okay, I wanna make sure that I don't lose too much money. So when it hits this percentage or this share price, I am going to sell my shares regardless of the reason. So you're going to have a very systematic approach, and you're just going to take emotion out of the equation. So to give you a quick example, if a share price is $10 and you put a stop loss at 10%, then your sell price will be $9. So the moment the shares hit $9, you're going to sell the shares. That's basically it for a stop loss. A stop loss is, as I stated in the previous video, is commonly used within day trading, and day traders are, once they have a lot of experience, tend to be very systematic investors, so they don't use emotion in their investments. And I think that is a quality that any investor should have, even though it is mostly common with short-term traders. So that is the stop loss. But using a stop loss in value investing or long-term investing, can also be growth investing, the main problem is, when are you going to re-enter a position, and how do you make sure that you protect the downside but don't miss the upside? Because that's basically what we all want, right? So let's think about the re-entry point. A re-entry point is also, once you make an investment and you've decided a stop loss, you are also going to decide when you are going to re-enter that position. So you could decide that, okay, I'm going to sell this at 10%, and if it hits 50% again, minus 50%, then I'm going to re-enter again and see how things go. That's obviously a big leap. Like how likely is it that it's going to drop that low? So that may be a bit risky, I might say. And yeah, there's other strategies as well. So for example, we can think about let's enter when it is 10% above all-time lows. Yeah. So that would mean, okay, it keeps dropping, but the moment it goes 10% up again, I'm getting in. That could be a tactic as well. But you need to, I think, what is very important with the re-entry method, if you have a company that you are a firm believer in, then you should have a re-entry method not based on, let's hope the share price drop this low. No, I'm going to have a systematic approach, and I'm going to get in once this or that happens. And it could be a percentage that goes up. I think that's probably best, because then you know that you're not going to miss the boat. But yeah, we'll get to the strategies in a bit. Let me just give you an example. If you do the same stop loss, but then you have a re-entry point at minus 50%, so a 50% loss on your initial investment, if that were to be the case, if you hadn't used a stop loss, then you were going to buy again. That means that your buy price would be $5. That is how you could use it. But what I would rather do is the same method, but for example, instead of a re-entry method based on an initial share price, you're going to do a re-entry method based on the share price, how it's been moving. So if it goes up again, could be 10%, could be 2%, could be 5%, could be 7%. You can decide this yourself. I'm not sure what I'm going to decide yet. But and I think it will be a lot of trial and error over the upcoming years to see what works best for me. But yeah, I think this kind of method is probably best. The problem is you don't know the buy price yet, so it's going to be hard for you to consider what your return is going to be. So in this case, if you're going to use this method, your main point is not going to be your return. It is mainly focused on, okay, what if I'm wrong and how bad will my losses be? So it's more protecting your downside. Then we have a few strategies, and I named some of them already. So the re-entry based on a predetermined price. This says, okay, if the share price drops 50, 60, 70, 80%, I'm going to get in again and I'm going to put another stop loss and we'll see what happens. The downside with this is you're trying to catch a falling knife, obviously, but it is a systematic approach. But the main downside will be, okay, what if I haven't decided it drops at minus 40? I'm going to buy in again at minus 40% of my initial investment and it goes to 35%. Then you're going to miss the boat. So in that case, you may want to consider actually do the dollar cost average method that we talked about in the previous video. Then you have a re-entry method based on recent lows. So you can say, okay, the share price dropped 50%. I don't know if it's going to drop more, but I'm not going to buy yet. I'll wait for the share price to go up by X amount of percentage again, and then I'm going to do the exact same tactic. So you could do the share price drops 50%. You have a stop loss and a re-entry method. Stop loss at 10%. Re-entry, you do not have that yet because you don't know if it's going to go lower, but it drops 10% again and then it goes up 5% and then 10%. So you're up 15%, but you decided to buy at 10% above the recent lows. So that will be around the 50% mark. So that's a method as well. And lastly is a re-entry method based on trading metrics. And this is something I will need to look in a lot more. Like in general, I am a believer that most of the trading metrics, at least for short-term trading, are not that telling as people may think. Some actually have some decent results, I might say, but that is a bit of an issue for me. But I think if you apply some of these metrics and you look at a longer horizon, and I've already seen some data about it, but I guess I'll link it in the description as well. I'll look it up, and you could see that if your horizon was 5 days or 1 day and you did a certain tactic and you bought based on X or Y trading metric, then your results wouldn't have been that great. But if you looked at the longer, like 20 days, 30 days, like I think they maximally went to 20 days, but there were metrics that would actually show that instead of around the 50, 49, 51 mark, you would get 56% chance of getting a profit. So some of these metrics might actually be good to implement in your long-term investment portfolio. But I think you'll want to see the Excel file. So let's get to that. So the moment you've been waiting for, let's go through the spreadsheet. First, here we have the data input. So it is going to calculate a lot for us, but I just want to start with the data input so that you understand that. First, you can put in your initial investment amount, and you could put in the share price as well. So we're going to know how many shares will be bought. And second, or third I should say, we're going to put in the transaction costs. I did a percentage, so depending on what you're going to buy, just make sure you put in a decent percentage. Then we're going to have a stop loss percentage, a re-entry percentage, and we will have a expected share price in 5 years, because we also want to know, okay, what does it do to our expected return? Because that's in general what we are looking for with investing. So once these are all the data that you need to put in, and afterwards it will do the calculations. You can also do the added money on re-entry. This is important for dollar cost average, or otherwise you're not dollar cost averaging, of course. And it assumes that you're gonna re-entry the dollar cost average moment at the same moment as the re-entry moment of the stop loss method. So I just want to show you a I think a method that we could use would be a stop loss at 10% and then a re-entry at 5% above the most recent low. So let's go through a worst case scenario, and that's this. So let's say the share price drops 10%, but it hits your stop loss, and then that is also the low, and then afterwards it goes up. Then you have to buy it at the minus 5% share price of the amount invested, of the amount investing. So let me explain that real quick. You have an initial share price of $10. You have a stop loss at 10%, so at $9 you sell, and then it only goes up, as I just said, sorry. And you have a rule for yourself, for your systematic approach, that you're going to re-entry 5% above recent lows. So in this case, the low would be 9, and then 5 would be 5% would be upwards, so minus 5% of the initial share price. Then look at the results. You can check it all the way you want, but I want to focus on the compound annual growth rate over 5 years. This is basically the average of the market, and that would be a total gain of €487.50 over $1,000 invested. And if you look at the stop loss and re-entry method, this would be worst case. So how would your portfolio do if you follow this tactic and you have a worst case scenario and you only do a stop loss once? That's also important. But there you see that it's just below 7% that your 5-year compound annual growth rate will be. However, if we change these numbers, and as I mentioned, I think in the previous slide that you should have a re-entry at based on a most recent low, but let's say we're gonna do it based on the initial share price. So we're basically gonna catch a falling knife, and yeah, we could actually apply the same method at 50%, minus 50% as well. And if it drops even further, then sure, another stop loss will be hit. So you can also do that, but the sheet doesn't do that as of yet. And let's say we're also gonna add the same amount of money again. So we're gonna compare the dollar cost average method. So no stop loss, but you do buy on minus 50%. And then we're gonna have a stop loss and see how that return would be. So same stats, a 50% share price increase over 5 years. With the dollar cost average, you will have a compound annual growth rate of just above 17%. And with the stop loss and re-entry method, you will have a compound annual growth rate of almost 23%. So that's a pretty decent difference, obviously, because the re-entry point is a lot lower as well. But let's now assume again that we don't add money to it. Then we see that if we don't add money, obviously we don't do dollar cost average, so our initial share price is 1,000, we don't benefit from the drop, and then we have just above 8% compound annual growth rate. But if we did the stop loss and re-entry method, then we see that we have a compound annual growth rate of 21.3%. So that's actually a lot higher. But now let's compare these numbers to an extra $1,000 invested. Keep a look on them. So 21%, 8%. Here you see this increases by 9%. This increases by less than 2%. So what I'm trying to say with this is obviously you should just, I will share this sheet with you and you can just play with it and create your own systematic approach if you want to use this method. But what I want to state is that if you don't have a lot of money and you don't have the ability to do dollar cost average, the stop loss method may be very good for you for your compound annual growth rate return, because you are just going to protect your downside, because you cannot add money on the downside. So if you just look at this again and see how it goes, then yeah, it's a pretty staggering difference. If you want to use several methods, so let's say you want to do a stop loss and re-entry method several times, so let's see if it goes worst case scenario 3 times in a row, then what I suggest you do is you take the results that come out of this and then you put them in input again. So it means you have to stay you have to memorize them or write them down, but yeah, I think that may be a method. And if it doesn't work, because I haven't tested it, because I don't think it's that important right now, and if you guys want something that to basically specify your systematic approach, then I can see if I can make a sheet that will do, let's say, 2 to 3 times, 4 times. Let's see what happens, because as I stated in the previous video, even if it drops 90%, a share price of $100 doesn't mean it cannot drop another time for 90%, and so on and so on. So you may want to apply this approach several times, although if it drops twice 90%, you may want to question your decision. But regardless, if you are still confident in that investment, you may want to do either the stop loss and re-entry method or the dollar cost average method. So that's it for today. I hope you guys learned something. Keep in mind that this sheet will be available on my website, and I will leave a link in the description. If you enjoyed this kind of content, please consider leaving a like. And for now, I wish you guys a great evening.